Well, hello and welcome to this webcast. I'm Mike Harris, Director of Financial Crime Compliance at LexisNexis Risk Solutions. This is the first in a new series of Financial Crime in Focus webcasts, where we'll explore the ins and outs of the new Fifth Money Laundering Directive regulations that came into force in the UK back in January. And along the way, we'll be asking, are they likely to have the intended impact on financial crime here in the UK? And also, what impact are they having on organisations that they've been imposed on? So in this edition, we're going to be taking an in-depth look at the crypto asset industry, drawing on some recent research which shows the emerging financial crime risks in the crypto sector, and which backs up anecdotal evidence that has concerned the authorities for some time. The nature of cryptocurrencies and their anonymity makes them unlikely bedfellows, perhaps, with regulation. We shall hear more from our expert panel in a moment on that subject. But now that crypto asset firms in the UK and Ireland are firmly within the scope of anti-money laundering regulations, after, as I said, the implementation of the Fifth Money Laundering Directive across the whole of Europe, we'll be exploring how two crypto firms have been busy implementing compliance frameworks that fully meet the requirements of the Fifth Money Laundering Directive, and are hoping to achieve early FCA registration and been on that journey for some time. Now, just to point out, we are still in lockdown during the COVID-19 crisis, so each of us is at home for this recording. So please do forgive any glitches or unexpected background noises. We'll obviously do our best to ensure that doesn't happen, but these sorts of hazards are around us at the moment. So joining me to help wade through this somewhat complex topic are three experts on cryptocurrency. First of all, Francesco Roda from Coin, that's spelled Koine. Also, Paul Bark from Archax, and Professor Nick Ryder, who's from the University of the West of England, and who, amongst other things, has recently written a paper on the regulatory minefield that crypto assets presents. So welcome to you all, first of all. Thank you for joining me today for this recording. And perhaps I can just ask each of you just to begin by introducing yourselves, what you do, a brief description of your work. So if I may, I'll start with you, Nick, from the academic world, and then turn to our two practitioners, Paul and Francesco. So, Nick.
Yeah. Thank you, Mike, and thank you for inviting me to participate in the webcast today. My name is Nick Ryder. I'm a professor in financial crime at Bristol Law School at the University of West of England in Bristol, and I'm head of research there and head of the criminal justice research unit. And my current research is on the links between terrorism financing, crypto assets, and social media platforms.
Great, thank you, Nick. We'll hear more about that in detail as we go through, obviously. Paul, perhaps you'd like to go next.
Thank you. I'm Paul Angus Bark. I'm a business analyst with Archax. Archax is looking to create an institutional grade exchange for the trading of tokenized assets. So very much like in a traditional exchange, except that the ownership is tracked through the use of blockchain and clearing and settlement instantaneous.
Right, thank you, Paul. And Francesco.
Hi, Michael, thank you for inviting me to this very, very interesting event. My name is Francesco Roda. I look after risk and products at Coine. Coine is a provider of custody, safekeeping, and settlement services to institutional investors for digital assets. That's our main core specialty. In the digital assets world, includes a number of different things, from the crypto assets or the decentralized cryptocurrencies like bitcoins, and all the way through digital assets representing securities. So it's a very, very interesting space. We're seeing a lot of development, and it's very, very exciting to be talking about these topics today.
Great, thank you all of you. Well, as you can see, we've got a very diverse audience, although with very interesting perspectives on this emerging space of crypto assets. And now that it's actually within the envelope of regulation, why don't we start there? So first of all, I'd like to ask you, and maybe I can turn to you, Paul, to start with, why do you think it was even necessary to bring the crypto asset sector within the scope of AML regulation?
From our perspective, because we wanted to have an institutional offering to participate, there's a need for regulations to be brought in because the institutions simply don't want to touch anything that isn't regulated. And we have to keep in mind that regulations are really about protecting the customers from bad actors out there. So it's a requirement if we want to bring it into the mainstream.
Absolutely. So in other words, you saw that you had to go down this route if you were going to play in the space that you want to as a business.
Yeah, absolutely. And as we're applying for an MTF license through the FCA, we already had to meet a lot of these requirements in the first place. So it really wasn't that much of a stretch for us to add on the additional MLD5 requirements. We had already had to account for that by lieu of our application.
Right. Thank you, Paul. That's interesting. And your thoughts, Francesca?
I echo what Paul said. I mean, we target and we serve the institutional segment of the market who's interested in digital assets. And clearly, regulations is about protecting investors, protecting consumers, and ensuring that the market function in an orderly fashion. So we pretty much welcome and are keen to adhere to the regulations to the highest possible degree. We have been AMLD5 compliant since our start, but we are also an authorized payment institution and electronic money institution. So we come under the AMLD5 regulations anyway. We think that this clearly the regulator has a keen interest. I mean, digital assets are effectively coming into the mainstream, and they are becoming a relevant part of the potential risk that the FCA and other regulators around the globe have to look at. So it's almost like a natural step for them to start looking at these in greater detail. Volumes are no longer irrelevant.
So in other words, for both of your businesses, it's very much seen as not just a business enabler, but a necessity in order to be serving the types of customers that you're going to be engaging with. So Nick, I'd just like to ask you the same question, but slightly differently. You've written a paper in which you explore the difficult things like crypto assets and social media platforms and social media platform payments and the challenges they pose to regulation. But briefly, what does your research tell us about the financial crime problem in these areas? Why are cryptos and social media platform payments so vulnerable to abuse?
One of the things that we've concluded with the recent study, which will be published later this year, is that there's increasing evidence that the links between money laundering and crypto assets are very well documented. We've got the Silk Road case, Silk Road 2 recently in the UK. But what's interesting is that it's obviously becoming a playground for terrorism financiers, and recent studies by the United Nations have indicated more and more people are able to access a mobile phone, a computer, an iPad and other tablets. So what we're finding is that the terrorism financiers are increasingly able to, firstly, I suppose, advertise for financiers on various platforms, whether that be social media companies or whether that be through the dark web. And then secondly, we're finding that because of the instantaneous payments are becoming quicker and quicker, it is becoming more and more abundant that this is the next form of terrorism financing by the internet. And this is partly how the attacks in America in 9/11 were partly financed, where the 19 terrorists used emails and text messages to indicate their plans and to indicate their sort of, in terms of funding mechanisms as well.
So do you think these were the sorts of things that drove the policymakers and regulators towards saying that we need to bring crypto asset businesses within scope of anti-money laundering regulations?
Partly, yes. I think that the Americans and Australians were very quick to regulate cryptocurrencies in the last 5 to 10 years. And I think that the UK eventually, obviously with the implementation of 5MLD, realised that there was a regulatory gap within its legal framework. But what's particularly interesting with the paper is that the admittance of threat posed by this mechanism differentiates between the National Crime Agency and the Financial Conduct Authority.
Right.
Our most recent national risk assessment, the NCA were aware of the threat, but were of the opinion it wasn't that much of a significant threat. Yet the FCA were arrived at a different conclusion, where they found more and more evidence of this increase in threat. So I think that there is if there's a criticism here, I think the UK's been a little bit slow off the mark with regard to implementing a regime to replace the previous self-regulatory regime for crypto asset providers within the UK.
Right, thank you, Nick. Interesting. So let's just turn back to our two practitioners, to Paul and Francesco, both vastly experienced in implementing regulatory compliance systems that meet the regulations themselves. And in fact, as we know, and you've already touched on, you're both in businesses where that journey has been ongoing for some time. But generally, for the whole industry, the crypto asset industry, it seems to me that it must be something of a shock to the system for the sector that actually jars with, what has been historically a very anonymous world where users of crypto assets are able to enjoy the benefits of anonymity. But what I'd like to do is just ask you to talk us through your journey towards implementing your controls, what you've had to deal with, some of the challenges, some of the obstacles, and maybe how you see this will be a benefit to not just your businesses but the industry as a whole. So again, may I start with you, Francesco, this time, and just ask you to draw a few thoughts out along those lines?
Sure. Just as a very quick preamble, I mean, I always provocatively, if you wish, say that to be honest, the currency of choice for fraudsters and criminals, it's still the dollars or the pounds, because that's what's the most fungible and the most useful from a value transfer perspective. So, having said that, and the reason why I'm saying this is that the interest from regulators and from crime agencies around the world is actually in avoiding and stopping criminal activity to the best extent possible. This is the current way that financial services work, is that the onus is actually on the intermediary to comply and enforce these type of controls. And that's not different, to be honest, with crypto, and it's not different with digital assets. And that's I think it's the great interesting concept that is coming through with regulations, with recent regulations, MLD5 in Europe, and I suspect that elsewhere in the world are effectively extending too. So the idea is that you hold the intermediary responsible for enforcing and enabling controls on KYC AML issues on any transactions. And that's what you do. As an intermediary, you comply with these rules very, very digitally indeed. Implementing these controls requires different steps. You still effectively look at your clients because that's ultimately the interest, the topic that you are most concerned of when it comes to KYC AML. And digital assets, so the asset itself, can carry additional information about your clients and can help practitioner to build a more refined and more accurate picture of the dealing of your clients. So in that sense, I see digital assets as almost like a step forward, if you wish, from existing financial markets where effectively the history ends with each individual intermediary. And then it's up to the authority, or if there is an issue, to request documents and investigate the particular entity that is holding the information about criminal activity. So the complexity lies in the fact that, of course, this is a new industry. So the players in this industry are yet to, I would say, come up with a very, very robust and well-refined data source or data propositions, because that's the core of information. The core of the service actually relies on accurate information about the quality and the history of assets. The digital assets, many are actually looking at somehow, I wouldn't say defeating, but get away from these controls by implementing technological change that increases the pseudo-anonymity that digital assets offer. So you can always track a transaction between two accounts, but you don't know who those two accounts are operated by or are owned by. At some point, if someone slips through some information on a public source, then you are able to join the dots and say, all right, this account belongs to this. And you can infer other information through clustering the addresses that you have information for on any given blockchain. So it's a very meticulous and very technical work where you need to kind of understand what the different approaches that the bad actors or the actors that want to evade or escape the controls take. So you need to understand concept like mixer. What is a mixer in this space? So it's a mixer is not, from a technological point of view, it's a piece of software or it's a piece some code. But from a purely, I would say, business, from a business point of view, it's just a standard agreement that exists among parties to try and hide what they're doing.
Okay.
When we look at our, when we train our staff, we always say, well, banks are effectively mixers when it comes to payments, because whatever comes out of a bank, it's a combined flow of different payments. So these are effectively the difficulties and the challenges, getting to grip with new technologies and new way that actors use to evade controls or bypass control.
Well, I think that actually is exactly what I was trying to drive at. That clearly we're dealing here with obviously a digital world, which is very different from the traditional world of finance. Paul, perhaps I can ask you to tell us something about some of the challenges that are particular to the crypto space. And I'm thinking here of some of the specific requirements of the Fifth Money Laundering Directive, which we've touched on already, but we will read about. And we hear that, there has to be, for example, full client due diligence undertaken in certain circumstances, that there has to be a record of payments, that there has to be, I think it's the so-called travel rule that says that you have, both ends of the transaction have to be fully documented. And in a digital world where there is no real jurisdiction and other constraints, how do you actually manage to do that?
Yeah, I have to say, I think I agree with everything that Francesco has said beforehand, but something to keep in mind here is the crypto industry should actually be welcoming or more endearing towards the regulatory landscape, because that's what's going to move us towards more mainstream adoption of the use of these cryptocurrencies.
Yeah.
The requirements themselves, when it comes to the due diligence that's required, whether it's on onboarding of clients or the actual transactions themselves, is really not that different from what the traditional financial world is doing just now. So there's definitely a lot of expertise out there that's able to help them with developing these programs and keeping these programs constantly adapting to the requirements and the changes going on. And at the same time, I would suggest that the crypto industry has something to offer for the traditional finance industry.
Right.
Because as Francesco noted, every transaction is on a public ledger. So you have a new class of investor out there that, for simplicity, we'll call the crypto millionaire. These kids that bought Bitcoin 10 years ago for pennies for a Bitcoin that are now worth $6,000-7,000.
Lucky them.
Yeah, and so now to be able to track the source of wealth, you need to be able to read through all the blocks of information, and that's what the crypto industry is able to offer. And so they can offer to the traditional financial world the expertise to be able to track back these transactions and show that the source of wealth came from a clean or somewhat clean investment rather than through some form of money laundering.
Interesting. So you're saying the very technology itself offers benefit in terms of maintaining records of transactions and customer accounts and an ease, well, ease is the wrong word, but identification of sources of wealth. It makes that much more, what's the word I'm looking for, possible, easier than in the traditional financial environment. So, that's an interesting perspective.
Absolutely, yeah.
Okay, Nick, I'd like to turn back to you because you talk about in your paper, you talk about a number of emerging trends, and you touched on them at the very beginning. And I'd like to go back to this whole notion of, well, two things really: social media platforms and platform payments, the vulnerabilities, the fact that they seem to fall into a grey area, i.e., they are not currently regulated. Should they be? What vulnerabilities do you see? And then, what should we be doing about them? And then I'd like to move into the whole area that you talk about quite a bit, which is the area of reporting, and SARS in particular, and defense against terrorist financing, to come back to your original point. So a few things in there, Nick, but perhaps you could pick up on those.
Yeah, I'd just like to say about agreeing with what Francesco said about despite the evolution of financial crime and cyber crime and so on, dollars and cash will still be how organized criminals and terrorists will like to get their hands on assets and finance. And what we're finding is that within the terrorism financing mechanisms currently is that terrorists have developed what we call a fraud dossier. So there will be a checklist of white-collar crimes they can commit that can go possibly undetected, so they can get cash, as opposed to maybe more risky transactions in terms of using financial institutions or other forms. But I think what we found within the paper is that there are several reported cases in America which continue to highlight the threat posed by terrorism financing via social media platforms. And I'll give you some examples. I mean, we've got a few instances in America where Gregory Lepsky was convicted of attempting to fund ISIS by using social media platforms and is serving 17 years imprisonment. Mr. Ali Amin, who was a 17-year-old student, was convicted of attempting to advise ISIS on Twitter how to mine Bitcoin. And more recently, we've had Zubia Shanaz, who I believe is serving 20 years imprisonment for committing bank fraud, $62,000, but then attempting to transfer that or to convert into Bitcoin to provide that to ISIS. So its evidence suggests that the terrorist groups are very tech savvy. They what we found with ISIS in particular is that their funding model is unprecedented, and it's what we've classified as a hierarchical or corporate funding model. So that means ISIS is run like a company. So they will pay their terrorists, they will recompense family members who relatives have been employed as suicide bombers. They have their own budget. They have a funding structure, which is similar to how the IRA were financed at its height in the 1970s and 1980s. So to me, the expansion in relation to new forms of technology is a natural progression for them. It even got to a point where ISIS, for example, had its own currency. And Al-Qaeda never was able to expand its geographical controls as ISIS were able to do until the caliphate obviously ended in the last 12 to 18 months. But what we're finding with the social media platforms is that there is a grey area. There is some uncertainty over the scope of the regulations. So, for instance, we've got the evolution of more crypto assets and Libra from Facebook. I believe that since October 2017, you can make payments by Facebook from one friend to another. So who polices that? Will it be Facebook? Will Facebook report it? Or will it be the debit card that's used? So there are some uncertainties into how payments made by social media platforms could potentially be exploited by terrorism financiers. And I think as both of the panelists have indicated, the extension of the 5MLD to crypto asset providers is welcomed. I think it does provide them with an opportunity to put them on the same regulatory footing as your other financial institutions. Obviously, within the UK, potentially members can then get, so people who buy crypto assets can then use the compensation scheme. Currently, of course, that's a problem, and that's been raised by the FCA on numerous occasions. But there are some grey areas that we've highlighted within the research that need to be looked at carefully by the regulator, and I think the social media platform corporations as well.
So we have a spectrum here, don't we? We have a spectrum of entities that are clearly operating well within the scope of regulation, and willingly so. And, you know, both of our guests today are in that category, to the other end, and clearly is using the opportunity for illicit activity in a range of ways, as you covered there, Nick, to development of tokens and digital type assets that can be used within social platforms that fall in this grey area. So, you know, there seems to me to be quite a spectrum that we have to try and deal with here from a regulatory or a governance perspective. Let's just pick up on the theme of reporting, and this will be to all of you. SARS, suspicious activity reports, clearly an integral part of any regulatory compliance program, and a vital part of information gathering and intelligence for the enforcement agencies and others to follow up on. May we just talk about some of that within the realms of crypto currency firms and crypto asset firms? So I'm going to come back to you, Paul, on that one, if I may. Just talk us through the process and how you see, is it adding value, is it working, etc.?
Well, I'd say really SARS will function the same as they currently do. I mean, really the only difference may be the ability to track transactions further if you wanted to. You're able to track it all the way back to the Genesis block if you really wanted to.
Right.
But yeah, otherwise I'd say largely it's the same.
Same process, because that's the mandated sort of compliance requirement, isn't it? And I guess my thinking here is that, you know, obviously this is a new practice for a lot of firms in the crypto space generally, maybe less so for you, but others that are now beginning to, you know, become mainstream in this regulated environment. You know, I foresee that this is going to be a bit of a challenge for them to get this right, to actually make sure they understand how the reporting requirements work, etc.
They may have to be ready to adapt to how this how it works, how they prepare these reports. I like to borrow from evolutionary biology. There's the Red Queen hypothesis, which takes its name from Alice in Wonderland, where in one scene, Alice is trying to get away from the Red Queen, and no matter how fast she runs, she can't get any further away. But as soon as she stops running, the Queen starts to catch up. And the idea is you have to constantly be changing, constantly be staying on top of things. Otherwise, the predator, prey, your nemesis, whoever, they'll start to catch up if you don't stay ahead of the curve.
Nice analogy.
Thank you.
Very good. Francesco, your comments around reporting in general and, you know, what you see?
I entirely echo what Paul is saying. I mean, we have a very strict and robust process to do the reporting, and a policy to actually guide our staff in this particular matter. And it's important to have this type of procedures and processes well documented, so that when you hit the point in which you have to trigger this particular, not welcome event, you're ready to do it in a proper way. So we've actually invited one of the police specialist units to effectively have a joint workshop to see how we could actually cooperate and make sure that the process worked well when it comes to SARS and potentially down the line confiscating assets as well. We had a very, very interesting exchange. And as Paul said, and I will repeat it, it's literally no different from a traditional SAR, where you have to report your suspicious activity, and and then you wait for your authority to come back with the results of their investigation. So the interesting point, we have actually accounts ready for assets that are being confiscated. Authorities are not all the way new to this problem. I mean, we've seen in the UK and in the US, we've seen auctions of confiscated bitcoins and other crypto assets that have taken place. Interestingly enough, they've been treated as commodities, so they've been auctioned through, usually commodity houses where these things were auctioned as objects rather than
right.
But that's just the way that they were these auctions were conducted.
You touched on something there, Francesco, which interests me, which is the role of the regulator. As we now know in the UK, the FCA is the regulator for the crypto asset industry. I think you touched on a meeting that you've had with the regulator, and obviously from the regulator's point of view, from the FCA, this is an entirely new sector they're having to get to grips with. So I'd just be interested to hear your thoughts around that and the challenges that the regulator themselves will have in understanding and getting to grips with being the regulator of this emerging and fast changing industry.
Yeah, so it's interesting because if in the words of the regulator, they are not actually regulating crypto firms per se. They're just registering them for KYC AML issues. So they are effectively the regulators which looks after this particular topic, but that doesn't equate to any registration at all. It's just any regulation at all, regulatory approval at all. It's just a registration.
Right.
So they keep, and I'm saying that because I see the regulators in the UK keeping at an arm's length when it comes to crypto. So they still consider crypto as a commodity, effectively, as something that doesn't actually come under their jurisdiction. And they appear to be keen to continue to do so.
Right.
So anything around crypto is actually claimed by the regulator to be under their jurisdiction. So if you have derivatives on crypto, then those come under the FCA regulatory regime. But if you are doing crypto to crypto exchange, which is quite a common business in this space, you technically are not regulated by the FCA. You are registered with them for AML purposes. So the test and the requirements, I understand they are quite taxing. We haven't gone through those because being a regulated entity, we already have been grilled by the regulator as part of our application and we are regularly grilled, of course, as part of our being a payment institution. But I understand that many of the new emerging crypto businesses found those requirements quite taxing, quite difficult to adhere to. And I understand that some also decided to effectively close down their UK presence because of this.
Rather than take it on.
Rather than take it on. So what I can understand is that they are effectively applying the same metrics that they would apply to a payment institution. They are probably extending the same requirements to crypto institutions, and that's what I believe that the guidance that I've seen suggests. In that sense, I guess, as we discussed previously, the requirements are still, the fundamental requirements are still unchanged. So you want to prevent, stop, and avoid the risk of money laundering and terrorist financing and any other inappropriate illicit activity being perpetrated. So all of the usual rules that the FCA imposes to regulated entities would then apply to businesses. I don't think I've seen anything particularly specific to the crypto side of the business itself, other than the usual due diligence on assets and due diligence on the source of funds and source of wealth of investors. But that would be no different from any other type of business.
Well, thank you, Francesca. That's a very interesting and full answer as far as regulators concerned. Paul, I'd like to sort of ask you if there's anything you would like to add to that, but specifically, would you talk us through one of the perceived weaknesses of the regulatory environment that we now have, which is, let's call it an unevenness around the world, you know, ranging from some jurisdictions where cryptos are still banned to others where there is a much lighter touch, to others where there's obviously a regulatory environment. And given the nature of the transaction, which can literally move around the world freely, what are the challenges that you might see and talk about there in terms of regulatory equivalence and how we deal with that?
Well, yeah, absolutely. As you alluded, we have the challenge of global compliance, not only in terms of the instruments themselves, but who's able to buy and sell them, and what venues are allowed to facilitate these transactions. So, I mean, there's a complete mesh of laws at the international, local, national level that we have to navigate to be able to ensure that we comply on a global scale. The only thing I would add to what Francesco said earlier, when he talked about cryptocurrencies being a commodity, that's probably more relevant towards the ICO model, the initial cryptocurrency offering. But there's a newer class of token out there called the security token,
Right.
which is like a cryptocurrency, except it includes an AML KYC component to it so that you can control who can buy and sell these tokens. And with the flexibility that these tokens have in terms of anyone can program them through smart contracts to behave however they want, they really can become any class of instruments out there. So they start to fall under the MiFID II standards at that point.
So I totally agree, Paul. I was referring to the purely decentralized crypto. So
yeah.
Anything that's has a sense of being a security in this country, it's come under rightly FCA jurisdiction, FISMA requirements for that matter.
And of course, you both allude to something that is quite perplexing from those outside of the industry, which is the constant evolution of different types and classes of tokens and digital currencies, and they have different labels and different sort of purposes. So keeping up with this for our audience that aren't directly involved, it is quite a challenge. There's no doubt. And I guess even within the industry, it's something that you guys have got to be on top of all the time. Nick, can I just ask you any thoughts that you'd like to throw in here when we're talking about the regulator and the regulatory challenge?
I think it's to be welcomed that the FCA are going to be the regulator of cryptocurrencies. I think it probably is the most strongest and appropriately placed within the UK. I think part of the difficulty we have with the extension of the 5MLD to this new form of finance is that the current SARS regime is littered with problems. So, for example, you've got things like increased compliance costs. How will that affect the crypto asset providers? Defensive reporting. And the quality of SARS submitted to the NCA appears to be very inconsistent. And of course, you've then got a fear factor. So if an entity reports what they deem to be a suspicious transaction, not necessarily because there's any hint of any financial crime there, but if the firm doesn't report, then of course they're going to be significantly or heavily fined by the FCA. So Deutsche Bank, for example, in January 2017 were fined £163.1 million. No evidence of money laundering, but simply because of weak levels of compliance. So these are issues which have been raised by the Home Office, various recent Select Committee reports, the Law Commission and the Financial Action Task Force in its most recent mutual evaluation report. But the biggest problem that I find is that from a terrorism financing point of view, is that all of these, the measures that were mentioned earlier in terms of Paul mentioned about the global UN, EU and FATF measures, is that they're all based upon looking for the proceeds or profits of crime. So essentially it's the money laundering reporting model, or what we call a profit reporting model. Well, is that necessarily the correct reporting system for terrorism financing, where the terrorists don't necessarily make a profit? So you're looking for not necessarily your Hollywood transactions, but you are looking for significantly maybe smaller sums of money.
Yeah.
And what the research had also concluded is that the most recent wave of terror attacks in the last 5-6 years, all throughout the world, are low capability weapons and low cost.
Yes.
So
Yeah.
I'm not aware of many or any SARS that have actually prevented a terror attack that's publicly available. So there is an argument that maybe it needs to be looked at again from a terrorism financing point of view, and also from a crypto asset provider point of view, because you don't want this emerging, exciting evolution of finance to be adversely affected by the way lawyers and banks are clearly adversely affected by the SARS regime.
Very good points. Thank you, Nick. Yeah, and clearly some challenges. There's a real sense that we're kind of learning together as we go along on this journey with these emerging assets. We're kind of drawing towards a close at the moment, so I'd like just to turn our attention to some practical advice for our viewers. Many of our viewers will be on the edges of the industry, looking at possibly becoming involved, or whether they have exposure without realizing it into the crypto asset sector. But many are learning and at different stages of the journey. Your two organizations clearly are much further along that journey. So I just, if you would, just ask you each to give, that's to you, Francesco, and to you, Paul, to start with, some advice, some top tips to others that you've kind of learned as you've gone along on this journey.
I guess, and I echo what Paul was saying before, I guess the world of digital assets is a very, very interesting world. It's a nascent industry, which is likely, in our view, to disrupt significantly the world of financial services, the world of effectively management and transfer of value from a professional point of view. And the world of digital assets is actually quite a varied world. So it goes, as we were saying before, from the decentralized cryptocurrencies like Bitcoins, which have a checkered past or are still being used or attempted to be used for illicit purposes. So they still carry a little bit of a stigma. It goes all the way through security tokens. So digital assets that actually represent something else, represent rights, represent equity, bonds, or other rights to value in the economy. It is an exciting world. It will bring, in our view, a lot more efficiency and transparency, and it will help the issuer and I would say the holder of value to distribute financial products more effectively. And on the other end, will help investors effectively lower barrier to entries and lowering cost in particular, and increasing transparency. So we think it's going to be a really positive revolution of the financial services industry, or maybe an evolution, if you wish, because this is a trend that we've seen for some time. ETFs are probably something that it's very radically different from the old world of mutual funds, but effectively they provide something very similar in terms of capabilities and functionality. It's just a much, much more accessible instrument. And that's where we see the industry moving. So my advice to our listeners is to actually keep an eye on this industry and look at the potential for improving distributions, improving liquidity of the product that it's being distributed. And from an investor's point of view, looking at lowering barriers to entry, lowering cost to invest. And that would be my advice.
Right. Well, thank you, Francesco. That's great advice. Paul, what would your advice be? What do you see that firms need to get to grips with now, and how do you see it evolving over the next sort of 2 years, 5 years, whatever?
So really what I would suggest is just to be ready to adapt to change. So whatever program is established, have regular reviews, whether it's quarterly or semi-annually, to ensure that it's still meeting the requirements that were set out originally. And I would suggest that that advice is just as applicable to the regulators as it is to the institutions out there, because they need to be flexible. They need to recognize that these instruments change on a regular basis, and what they have as a framework now can possibly be applicable, but it may no longer be applicable to any future instruments that are created 6 months from now. One of my coworkers likes to call this the democratization of finance.
Right.
And it just goes to show the amount of creativity out there when you sort of give anyone the opportunity to create an asset from computer code. A good example is flash loans. That's something nobody had ever heard of before, and now it's quite common to talk about it within the crypto industry anyhow. So yeah, I would just suggest that be ready to adapt to change, and that's applicable to the institutions and the regulators.
Yeah, thank you, Paul. So coming to you, Nick, to sort of bring us to a conclusion here. Slightly different question. I'm not giving you a crystal ball here, but maybe a magic wand. Thinking about the issue strategically, and from a policy making perspective, if you could wave that magic wand from all that you've researched and looked at in detail, what would you say? What proactive action? And maybe what would be the key areas that you would say we should address as we embrace this whole new emerging technology trend?
I think the key area for me is that with the research, we were able to identify what we felt was a very good model to go forward. So in 2015, the government created JMLIT, Joint Money Laundering Intelligence Task Force.
Yep.
Which allows for the voluntary exchange of information. Now that's important for a number of reasons. If you think about the previous weaknesses I mentioned with the SARS regime, high levels of compliance costs and fear factor, because JMLIT is exchanging information on a voluntary basis, there is no fear factor argument here. And the current membership of JMLIT are UK banks, credit card providers, and so on, and they cover about 89% of all of UK bank accounts. But to me, evidence released by the government suggests that within 12 hours of the London Borough market attack, they were able to identify the credit card used by using JMLIT, which is unprecedented. So 12 hours from attack to determine the finance, and they were able to then ascertain that there was no broader terrorist cell. So for me, you extend the remit of JMLIT, you broaden it to include maybe your social media platforms, maybe your crypto asset providers.
Yeah.
And you end up with a more joined up approach. Because the membership of JMLIT is quite narrow, so lawyers aren't members, estate agents aren't members. So Law Commission discussed this, and evidence provided by the NCA and police forces was rather non-committal. So for me, it would be to extend the remit of JMLIT to encourage the exchange of information on a voluntary basis. And I think the FCA has to be applauded by actually beginning to provide a stronger platform for these very exciting and innovative financial institutions. So it puts them on a level playing field with the I suppose, the more popular, the more traditional means of financial service providers. Because ultimately, of course, it is about protecting consumers. And if consumers can be confident by using the crypto asset providers, then it might lead to more diversification within the financial services sector.
Thank you, Nick. Good points, and certainly your point on information sharing, the role of JMLIT in all the research that we as an organisation have done over the last 3 years. This point comes out time and time again. If we're really going to get on top of financial crime, then we have to have a much better information sharing culture, the ability of financial institutions to share information between each other, and obviously for the role of organisations like JMLIT, as you've talked about, to be expanded to ensure that there's a proper forum to bring in input from a wider spectrum of the financial services sector. So thank you for those points, and they've certainly been backed up by all the research that we've done as a firm. So I think we've just about come up to our time. I'd like just to whiz around the room once more time and just give you a final thought to leave us with. And I'll go back, as we started on this round, to you, Francesco. Is there anything you would like just to say to enthuse us, to inspire us, that we should take away?
I think I'll look back at our experience and what our clients are telling us. So there is definitely an appetite for digital assets within financial services. The benefits of digital assets are being understood, I think the industry is moving probably in the right direction when it comes to effectively the key players, the key stakeholders in the process, understanding what the real benefits are, and having this almost escaping from a pure technology play. And I guess it's interesting to see what the next 2 or 3 years will produce in this this space.
Yes.
And I expect a very, very steep change and a very, very good take-up.
I think that's going to be clear. We're moving into an area that is changing almost daily. Paul, your final concluding thoughts for us.
I think it's an exciting space to be in, and I think we're hopefully going to see more mainstream adoption in the next few years. I think there's a growing appreciation of the underlying blockchain technology, and I suspect that capital markets and financial institutions will start to adopt the use of it more because of the efficiency that it will offer to their operations. Just think of all the cost savings to reconciliation alone that could come into effect through blockchain.
Fantastic benefits and opportunities in that alone. That's a very good point. Thank you, Paul. Nick, one final thought from you?
I just think for me that it does represent a very exciting time for the financial services sector, but I think it's important to realise that from a law enforcement, financial intelligence perspective, the tools already exist to tackle this new form of finance. So I think somebody mentioned earlier about confiscating look at the Grant West case, where a cyber hacker and the police confiscated nearly, I think, £900,000 of cryptocurrencies. So if the courts are allowing law enforcement bodies to use the traditional powers, then I don't think there needs to be a lot of legal alterations. It's about the law enforcement bodies actually using these powers to test the water. So case law will then hopefully give us a clear, like what we call judicial precedent, to use these powers to tackle an emerging form of finance, but also to prevent it from being tarnished with illicit finance and funding of terrorism and fraud as well.
Yeah, fascinating. Thank you all. Thank you. For me, I guess the takeaway is I've learned an awful lot from the discussion with the three of you. So thank you for that. And I hope our audience has too. B is a kind of a fresh enthusiasm for what's happening in this sector. It really is exciting. I hear a lot of comment from within the financial services industry as a whole, and that predominantly is in the traditional end of the business. And many firms have stood on the sidelines, not actively become involved in the crypto industry, and really being quite nervous about it. But it seems to me, and you three have very much confirmed, that it's a bit like King Canute trying to stop the tide coming in. It's going to happen. It's going to become more mainstream, and I think the message for me is let's embrace it, and let's enjoy the development of what is a fascinating and embryonic industry. So really good discussion. I'd like to thank all of you. Thanks to our expert panel, to Paul Bark at Archax, and Francesco Roda at Coin, and Nick Ryder at the University of West of England. Thank you sincerely for joining this webcast and providing your expert input, and personally to wish you every success in all your respective endeavours. Stay well, and I hope that we can actually physically meet in the not too distant future. And to the audience, thank you for joining us. Thank you, and I hope you found it useful. And if you do have any thoughts, questions, or comments, please do use the email that you'll see on your screen shortly, and get in touch with us. And I'm sure our panel will be more than happy to answer any points that you might raise on the back of hearing their comments today. So thank you all, and goodbye.